Getting started as a new investor may feel overwhelming. There are many investing strategies and a ton of information, so it can sometimes be tough to figure out where to begin. A good place to start can be by learning what not to do. So, let's walk through some common mistakes that some new and even seasoned investors can make. Investors sometimes jump right in and make their first trade without creating any sort of plan first. While it doesn't have to be written in stone, a plan can help guide decisions and determine things like your investment goals, your timelines to achieve those goals, and your tolerance to risk. A plan may also reduce the possibility of investing according to your emotions, which can help you to stay the course and not buy or sell on impulse. Some investors don't think about how long they want to hold on to their investments. This can increase the likelihood of impulse decisions down the line. On the other hand, planning an exit strategy can help iron out important criteria, like target return percentage or target timeframe. Setting targets can help you make rational decisions about when to sell your investments. While investors might generally be willing to take on some risk for the possibility of higher returns, it's important that they not take on more risk than they can manage. One way to manage risk is by understanding which securities to invest in. Should your portfolio be overweight in a specific stock, or should it be more balanced? Will you invest in one industry or one country? These are examples of the types of questions that you should ask yourself when determining your risk tolerance. When investors have a portfolio that's doing well, many are naturally excited to track the progress of their investments. However, if those investments are not doing so well, some investors may be inclined to avoid reviewing their accounts. It's understandable. It can be hard admitting to a mistake, especially when it involves our hard-earned money. Here's the good news. Almost all experienced investors have made investing mistakes. It's how we learn from those mistakes that can help us become more successful. The first step on this journey is to monitor portfolio performance. By doing this, we're giving ourselves an opportunity to assess progress on our investment goals and make adjustments to our investments when necessary. A common practice for many long-term investors is to review a portfolio on a quarterly basis. Checking too often may entice investors to trade according to emotion as the markets fluctuate. If you decide to check in more frequently, be mindful of keeping those emotions in check and sticking with your plan. Investors can be attracted to the stock market because they have a get-rich-quick dream. This can happen when the market is doing well or when a trendy stock or sector, like gold or technology stocks, is talked about in the news or by word of mouth. While some investors might be afraid of losing out on a great opportunity, the reality is that trading opportunities are never fleeting. Every day presents new opportunities to invest. If investors research and are prudent when building their portfolio, investing can feel not only enjoyable, but manageable too. It can be easy for investors to seek out information that reinforces beliefs they already have, and ignore information that refutes those beliefs. This is called confirmation bias. As a new investor, it is important to take a more balanced approach to all information and be cautious of letting emotions dictate decisions about trading. Whether someone has been investing for a few days or a few years, learning how to become a better investor never ends. If you're a new investor, you might want to learn about the market and foundational investing concepts. But, as with anything, continuous learning can help you make informed decisions and feel confident about your financial future. Not researching or having a plan in place can add unnecessary stress, so it's important to keep an objective and open mind and make informed decisions.